under pressure, there has been a sequential decline in margins and some deterioration in their asset quality. Ashok Haldia, the MD and CEO, joins in next. Good afternoon, Mr. Haldia. Let me start with the asset quality. You know, we got a lot of comfort in your Q2 numbers when the gross NPA ratios improved by 150 basis points. But this quarter, again, there has been, this time there has been a reversal. Your, gross NPA ratios have actually deteriorated. Do you expect a further spike in your gross NPAs going ahead? What happened to the asset quality this time around, which led to the weakness?
All along on the assets quality, we have been maintaining the assets which have some kind of stress are around 1,000 crore. And that amount stands. And within that amount, there could be assets which would be flipping from stress to NPA or maybe from NPA back to the stress. This quarter, there is an asset and only wind farm that we have financed in the state of Maharashtra as a debt, for which the PPA was not signed for last 12-13 months. They were still servicing our debt. Now that PPA is expected to be signed in next couple of weeks, and this loan would be again back to a standard asset. The loan amount was about 58 crores. So what I'm trying to say is that our overall stress in the assets is about 1,000 crore. Now within that 1,000 crore, the amount could be flipped into a NPA or flip back into a stress assets. So I don't see any in terms of deterioration into the quality of the assets that we hold.
All right. So, Mr. Haldia, you're trying to tell us that the asset quality will not deteriorate from these levels?
Yes.
All right.
The quantum that I've stated.
Okay, all right. I wanted to ask you, sir, about your loan book. In the last few years, your loan book has moved so well from what, 4,900 crores. Currently, I think it's closer to around 9,500, 9,600 crores. On a sequential basis, that grew by only around 2%. Where do you see your loan book going to in the next couple of years? Yes.
We have been growing constantly at the rate of between 25 to 30%. And this quarter, there has been a significant change in terms of the way the renewable projects are getting themselves financed. We have about 600 crores of the non-fund based disbursements against the sanctions. Now all these non-fund based commitments would get converted into disbursement into this quarter or the subsequent quarters. So I don't see there is any concerns on account of the loan book growth, because these non-fund based commitments are not forming part of the loan book, the figure that we have given. And let me also tell you that during this quarter, our sanctions have been more than 3,000 crores, more than 125% increase on year basis. This year, up to 9 months, we have sanctioned 8,000 crores compared to 6,500 crore in the entire year last year. So and 85% of these assets are the renewables. So these all would be ripe for disbursement this quarter or the subsequent quarter. So all that we have been maintaining all along, that the growth in the loan book of the PFS, we should be able to maintain the 30%, and I still maintain that we should be able to grow by 30% and even more.
Okay. Mr. Haldia, while your cost of funds is down by 18 basis points, your spreads have declined by 77 basis points to be precise, and I'm looking at it on a quarter-on-quarter basis. Could you explain that for us and what your outlook is on cost of funds, NIMs and spreads going ahead?
It all is been changing because the change in our business model and the portfolio mix. As I said, we have about 50% in our total portfolio, the renewables. The renewables have a lower implementation period. So the moment they get converted into a commercial operations and their operation financially and operationally get stabilized, the risk premium that we add in terms of the lending that get reduced, and then to that extent the interest rates up to 100 basis point gets reduced. So that's what one of the reason that the yield has come down. But at the same time, the risk associated with these projects have also gone down. So so we have to see risk with respect to the returns, and to that extent I would feel that the reduction in the yield is not a cause of concern. The second thing is that while our the interest cost has reduced after 1st of January because of the banks reducing their base rates. But we had passed on the interest rate reduction by 25 basis point in the last quarter itself. So this quarter and the subsequent quarter, that should help us in maintaining our spreads.
Okay. Thank you, Mr.